Shared office space provider WeWork says it lost billions of dollars last year as the coronavirus pandemic forced the closure of its facilities. Now it's wooing investors for another $1 billion injection and a stock market listing. WeWork plans to merge with a special purpose acquisition company to achieve both goals. And as Mobin Nasir reports, it's just one of dozens of companies securing funding through Spacs.
Social distancing requirements and lockdowns brought on by the coronavirus pandemic may have changed the office forever.
The thought is that by having these environments where employees can congregate, where they can just bump into each other, that will drive positive outcomes. And so that's the way a lot of organizations have configured their workspaces. And now we're talking about really a dramatic reversal of that, where we're going to go back to the days where we have barriers put in place to separate employees and to maintain distance among employees.
Shared office space provider WeWork is among the biggest casualties of this trend. The company was already struggling to contain costs before the pandemic. In 2019, the board fired co-founder and CEO Adam Newman, shelved plans for an IPO, and laid off more than 2,400 workers. Last year, it lost $3.2 billion as people steered clear of crowds and limited their social interactions. Now, it's trying to revive its business by partnering with various trade bodies in the US and other countries.
As we look to help foster economic growth across the nation, cross-sector partnerships are a powerful way to make a positive impact for individuals, businesses, and communities.
It's also reviving plans to go public by merging with a special purpose acquisition company, or Spac. Sometimes called blank check firms, Spacs are companies whose sole purpose is to raise money from the public by listing on stock exchanges. They then use this money to buy existing companies. Such firms are gaining in popularity as low interest rates in the US and other countries allow deep-pocketed individuals and companies to borrow and invest more. Basketball star Shaquille O'Neal, former US House Speaker Paul Ryan, and tennis champion Serena Williams are among dozens of celebrities investing in Spacs. They helped betting website DraftKings, jobs portal Opendoor, and Virgin Galactic, Richard Branson's space venture, list on stock exchanges along with more than 200 other companies last year. In the first 3 months of this year, 264 new Spacs have been launched. They've raised more than $79 billion during that period. That's roughly equal to the total funds raised by such firms over the whole of last year. By jumping on the Spac bandwagon, WeWork could convince more investors to give it the funds it needs to stay afloat. But experts say the company's core operations are facing an existential threat.
But I think in the long term, a lot of companies are going to, having gone through this, are going to realize that maybe remote work is feasible in a lot of jobs and situations where maybe in the past they really didn't think it could work.
Unless it can get people back into its shared offices, the writing could be on the wall for WeWork, even with the help of a blank check backer. Mobin Nasir, TRT World.
Well, for more on this, Santosh Rao joins us now from Princeton in New Jersey. He's partner and head of research at Manhattan Venture Partners. Great to have you back with us, Santosh. Now, we know SPACs are all the rage on Wall Street right now. Everyone's talking about them. Can you explain what they are exactly in your own words?
Yeah, so SPACs are essentially blank check companies. So these are vehicles created, they just come and they raise money in the open market, and then they have 2 years to go out and buy or merge with another company. So it's an empty shell in the beginning when they do an IPO, and then they go out and they in 2 years acquire a company. So that's the name of the game, and that's how the SPACs are working. And so that opens up a whole wide field. They don't have to disclose as much. So these SPACs can go and, like a company like WeWork, it doesn't have to disclose anything. Only the sponsor of the SPAC knows what this company is and the few investors. So the general public does not know what the inner details of the company that they're acquiring. So it's a little, and it's being looked at, it's a little complicated in that sense, and they get a free pass into the public markets. So that's where it is at this point.
According to Spac research, the amount of money that's been raised through Spac so far this year is around $88 billion, and that's more than the total amount that was raised in all of 2020. And even in 2020, we saw Spac activity basically quadruple. They've been around in some form since the 1980s. So why are we seeing such a boom in Spacs right now?
Well, we've had some successes. Originally, we had the DraftKings and Virgin Galactic and very high-profile sponsors. So it's become very profitable, or rather, certainly it's become very popular. And so there's a lot of money out there. There's a lot of liquidity out there. So there's a good way for anyone with big pockets, deep pockets, to go out, create a SPAC, and then acquire a company. So it's just caught on, and I think that it's a simple fact is that there's just a lot of liquidity out there, the number of companies out there looking to come into the market, and the SEC has allowed this to happen. So nothing wrong in that. There's no legal issues in there, but there is a very high risk in this whole category. So I think people have to be careful because you really don't know who they're going to acquire. You're buying the SPAC with the hope that they'll buy something better. They give you some indication that who they're going to buy, but they're not obligated to do that. So we've had cases where a cannabis company, SPAC, ended up buying a biosciences company. So we are seeing things like that. So at this point, there's just too many SPACs out there looking for merger candidates. So I don't know if all of them can really fulfill their mandate at this point.
Let's talk about another one of those risks, and that's just how quickly SPACs can take a company public. You mentioned that it's seen as a bit of a loophole in terms of an IPO, and indeed a SPAC can take a company public in 2 to 3 months versus 2 to 3 years in the traditional IPO process. Can I ask you about that WeWork example? Because we know it was formerly a unicorn darling. It had looked to go public back in 2019 when closer scrutiny of the business and its founder, Adam Newman, basically put a stop to that. But now WeWork, as we heard in Mobin's story, is looking to go public through a SPAC. Are you worried that perhaps SPACs are being used as a loophole to avoid the scrutiny and the regulatory loopholes that the traditional IPO model essentially forces on a business?
Absolutely, absolutely. And that's a big issue that's coming up in front of the regulators. How can you let go of certain companies? The traditional IPO companies, they have to go through a due diligence process. There's a kind of there's a weeding out process by the time they come to the market. But here, you really don't have to disclose anything. Only the sponsor knows who you are. And so you just jump into a public company, become a public company through the back door, essentially, and then you're out there. So nobody really knows. And even usually, invariably, the profile of these companies that they've acquired are companies that are way away from profitability. The revenues are still, some of them don't even have any revenues. So they're highly speculative companies. So only the SPACs can really withstand that risk. But the general public doesn't know that. So I think there's a lot of risk associated with this. The whole risk-reward profile of these SPACs are suspect in many cases, are unfavorable in many cases. So I think you have to be very careful in terms of looking at it and seeing what they are. I wouldn't jump into this without really waiting and seeing if they can really perform the way they're supposed to.
I guess with any type of risky asset, the mantra is buyer beware. Santosh Rao, we'll have to leave it there, but thanks as always for joining us.